Interest rates have risen again, in a move that could send the housing market into a tailspin and even put the economy at risk, as the RBA battles high inflation. But the rate hiking cycle is far from over. Official interest rates rose by 25 basis points to 2.6% on Tuesday as the RBA board met in Sydney to find a way to stamp out rapid widespread price rises. The increase in interest rates over recent months has been required to bring inflation back to target and to create a more sustainable balance of demand and supply in the Australian economy, said the RBA governor in a statement. The RBA board is committed to doing what is necessary to ensure that inflation in Australia returns to target over time. Rates have risen extremely quickly, from 0.1% at the start of the year to 2.6% as of Tuesday. It's the sixth consecutive rise in as many months, and they could rise further if some predictions are to be believed. Which predictions should we pay attention to? Talk is cheap, but some people put their money where their mouth is, in interest rate futures markets. Those markets are predicting rates will rise until a peak in March 2023 at just over 3%. That sounds like a lot more rate hikes to come, but as the next chart shows, forecasts from not long ago were for even more aggressive rate rises. Recently, expectations have become more muted and even hint at falling rates in the second half of 2023. Inflation, the old enemy. Defeating inflation has been one of the big triumphs of economic policy in the last 30 years. Now, with fuel at over $2 a liter and $9 lettuces, that victory is at risk. The word inflation refers to persistent, widespread price rises. High inflation is considered bad, not least because it erodes the buying power of savings. If you had $1,000 in the bank a year ago, it now buys around 6% less thanks to our 6% inflation over the last year. Inflation hurts anyone with money saved up, like retirees, although it helps anyone with debt, because the real value of the debt gets smaller. But the reason we fear inflation runs deeper than that. When inflation sets in, it changes inflation expectations. Anyone bargaining for wages demands a high percentage lift each year, and those higher costs flow through to higher prices, and we can get stuck in an inflationary spiral. Nobody gets better off, but prices keep rising. Then the only way to bring inflation back down is to really crunch the economy. The RBA's hope is to get inflation back under control before inflation expectations move upwards permanently and without sending the economy into recession, a challenge that the governor has described as a narrow path. Runaway price rises. The RBA's job is to control inflation. It's failing, as the next chart shows. Inflation has shot far above the target band of 2 to 3%. Why does inflation happen? A company will lift prices when they have more customers than they can supply. Think about a tradie whose phone is running off the hook. Suddenly he will add 10%, or more, to all his quotes. If lots of companies are in that situation, they all raise prices and we get widespread inflation. Then the RBA steps in, lifting interest rates. This has three main effects, all of which are about reducing the need for companies to raise prices. Data shows that 80% of people watching my videos are not subscribed. Remember, subscribing is free, it only takes a couple of seconds and you can unsubscribe at any time. Please help me and my channel by subscribing. Now back to the video. Households have less money to spend because people have to put more money to their mortgage. Businesses spend less because the cost of borrowing money is higher. The wealth effect: when interest rates rise, house prices fall, people feel less wealthy and spend less. You will notice one thing in common about the above: making Aussies feel poorer so they spend less. Yes, fighting inflation is painful, which is why we want to keep it under control in the first place. There are a few other ways monetary policy works, which are also about generating less spending at Australian businesses. People save more when interest rates are higher. If they're saving more, they spend less. The exchange rate rises when interest rates are higher, making imports cheaper and domestic goods more expensive by comparison. This works in theory, but at the moment most central banks are lifting interest rates. And some are hiking much faster than Australia, so our rate hikes probably only stop our dollar getting weaker, don't actually make it stronger. When house prices fall, fewer houses change hands, and we spend less on real estate agents and conveyancers, removalists and furniture. Moving house usually makes people buy new stuff. All 6 of these reduce the amount of money Australians are spending at domestic businesses. That's not fun for anyone. It makes things feel tight for households and businesses alike. Will it work? It will if the problem is the one I described above, that they have more customers than they can supply. But of course, at the moment, a lot of inflation is about import prices. Putin has upset global markets for wheat and oil with his war, and prices are sky high. Crushing Australian household budgets under enormous mortgage repayments isn't going to move the dial much on petrol prices, for example. So there's reason to be skeptical of whether the RBA really can beat inflation back quickly even if they lift interest rates as fast as predicted. The narrow path the RBA is on might actually be more of a tightrope walk.